Hey everybody, welcome back to the channel. We have some interesting stuff to talk about today. The consumer inflation report just came out and it's about 7.5%, which is higher than it was last month at around 7%. But growth stocks, Palantir, SOFI, Open, Roku, these types of stocks, ARK Innovation, are not dropping. In fact, they're actually holding up pretty well today or even up a little bit today. What is this paradox? If inflation is bad for growth stocks, because inflation obviously means the cost of borrowing money gets higher because the federal government has to raise interest rates to combat inflation. They have to make it harder for people to borrow money so that they can get less money into the economy. Means that growth stocks that are not going for profitability but going for market share and that usually tend to borrow a lot of money have to pay more for that money, which means it becomes riskier to invest in those companies because in general, we don't know how well they're going to do given inflation is happening in the market and given they're going to have to spend more money to actually make more money and they don't have any profits to show for it. These types of stocks should be down. These types of stocks should not be doing well when there is high inflation. And already we've seen that they've come pretty far down. But because they've come pretty far down, Palantir at 29, Palantir getting all the way to 11. You talk about Roku at 340 something, now Roku being all the way down to 160. Is there a world in which inflation is already baked in, the consumer reports about 7 to 5% don't really matter, supply chains are getting better, inflation is going to be transitory, and ultimately the market is proving they do not care about these higher inflation averages? Let's talk about this right now. So first, let's give a little overview on the inflation report that just came out. The U.S. rate of inflation climbed again in January to 7.5% and stayed at a 40-year high, suggesting upward pressure on consumer prices is unlikely to relent soon, which means the federal government will likely have to act. The consumer price index rose 0.6% in the first month of the new year, driven by big advances in rent, food, and energy. These were the three big ones. They increased Wall Street forecast of a 4% gain. The 7.5% surge in the cost of living in the past 12 months is the biggest since February of 1982. So since the 80s, we have not really seen the type of inflation that we are having, that we are seeing right now. A couple more things. A separate measure of consumer inflation that strips out volatile food and energy prices also rose 0.6% last month. The increase in the so-called core rate over the past 12 months moved from 6% to 5.5%. That's the highest level since August 1982. So inflation is here. Inflation has gone higher than it was back a month before. Consumer prices are increasing. Energy, food, rent is increasing. Oil prices are starting to become astronomically higher, not only because of the geopolitical issues mainly because of the geopolitical issues in Russia and the Ukraine, but in general because demand is surging as well, which is why those prices have to be able to raise. Why doesn't this mean that growth stocks are crashing? So if you look at if you just look at the market right now today, many things are pretty much in order. Palantir is at $14. Palantir ended the day yesterday at $14 after hours, right? And I think it rallied from like $12.97 all the way up to $14. It should be down. This is bad news for a stock like Palantir. ARK Innovation at $77. It's up 2% on the day, and for the week it is up 11.2%. So up 11% week to date, up 2% on the day when inflation comes out and this news ends up being bad. So what's happening? Why is this actually going on? The first thing I want to do is reference a Twitter thread from someone that I follow that I really highly respect on Twitter. I've been investing for a very long time. He did a podcast with Dave Lee a while back. I'll leave that in the description, and I'll show a screenshot as I'm reading this because it's important to understand how this person thinks about what's going on in the market. He is long on a lot of growth stocks, and this is his reaction. The market's reaction to the news is more important than the news itself. Stocks stop declining when the worst has been discounted. High growth stocks taking today's inflation shocker in their stride. Notable, no real bloodbath thus far, bottom processes is underway. The vast majority of the high growth stocks have gone up today. ARK is also green despite weakness in the indices. The market is sending a clear message. And then he shows a picture showing, here's today's reaction to the terrible CPI print. It was terrible. It was not good. When stocks rise on bad news means we are past the puke point. The crash is in the rear mirror. And if you look at that picture, it basically shows that once the inflation news came out in pre-market and going into the market, most stocks were up. If they were down, it was like 0.07% negative. It really wasn't a reaction like we saw in January to the federal minutes that came from December when the Fed was talking about inflation. I mean, the entire market just like flopped when the reaction to those minutes came out. So let's talk a little bit about what Puru is saying. The first thing he's saying is that when stocks stop declining, when bad news comes out, and again, this is bad. 7.5% inflation is not good. That means they are likely near to finding a bottom. Now, I don't know if this is true. I don't think I've been in the markets enough to actually understand if this thesis is correct. I trust someone like Puru who has been in the market for a long time, but logically I can sort of understand what he's saying, that if the worst of the news comes out and the market simply doesn't react to it, meaning institutional investors, hedge funds, retail, etc., are not selling off their stock to minimize the amount of pain that they're going to have as a result of buying that stock earlier, or they're not taking the small profits they got from Monday buying it on Wednesday, which would lead to a sell-off, right? And the motivation for that sell-off would be the inflation report, so they would want to take their profits while they have it. That means that the market might be forming a bottom. Because when bad news can't affect the market anymore, it's hard for the market to get worse. Think of what happened during the pandemic in 2020. We had a sharp decline around March 18th, March 24th, that whole week during COVID. And then immediately it started rising. And there was worse news coming out every single week. I mean, people were dying here. Hospitals were overcrowded. Stimulus wasn't on the way yet. This. I mean, there was so much news coming out. And still, the market persisted to have one of the greatest rallies of all time. It was insane knowing people literally couldn't pay rent and people are making millions of dollars in the stock market. So in a world in which the stock market is immune to some of the bad news that is happening, there is a chance that a bottom is forming. And at least in the pandemic of 2020, the bottom was formed in March, and then we went on. As a result, the same thing may be happening here. Now, we've already had a substantial major crash, right? Like, I mean, some stocks are down. ARK is down basically almost 50% from its all-time highs. So, like, to say that there is more downside for the market is a little weird right now. And maybe there is. Maybe I'm totally wrong about this. Maybe, like, maybe a lot of people are wrong about this that are speculating it. But to say that there is even more downside, like, where is the downside going to be coming from? Right? Because to assume we haven't found a bottom yet and assumes there is more, that assumes there is more pain. So like the thesis is growth stocks are not crashing because inflation reports came out. Inflation was bad, but the market is already so low that they're not selling off, which means theoretically there is a bottom. If you disagree with that statement, which you can disagree with that statement and you may be correct, then the logical argument would be to prove where else there could be a bottom coming from. You got to look at some of the big names that are already bottomed out. Are we going to get a bottom from Facebook? Yeah, one of the things I've learned over the past couple of weeks of really analyzing the market is that some major companies hold up the entire stock market, right? So when I'm on Twitter and people are like Snapchat saved the market today or Amazon saved the market, it really does make sense. Like these stocks doing well ends up saving a lot of the bad and a lot of the pain that is going to happen. So where is the bottom coming from? Because you've already had a basically $900 trillion company, Facebook, lose $250 billion of market cap. I mean, at some point you realize when Facebook is trading 16 times free cash flow and has 3 billion users that 10 million advertisers want to access, it's very harder for it to necessarily lose another $200 billion in market. Like these are real businesses at some point. Like the algorithms just don't make any sense anymore when it comes to a lot of this trading stuff. So what, Facebook has more downside? What, Amazon had amazing earnings, Google had amazing earnings. All the growth stocks that didn't have amazing earnings, they're already down. So it's like, what, is Palantir going to go to $6, $7, $5? It's like that. That's what you're saying with all the news that's coming up about what they're doing and they're having earnings soon. Like theoretically that's possible, but to say that there is even more pain to come, it would make sense if you said that anytime in 2021, like when valuations truly were, you could say ridiculous, right? Palantir at $45, like barely a year after they DPO'd, you could definitely say that was ridiculous. And you could say a lot of other stocks like Zoom being at $500, that was probably ridiculous. But we're not at that point anymore. All of those stocks, plus a lot of other stocks, down the toilet. And they've been down the toilet for the past 3-4 months. So to say they're going to go even more down the toilet, meaning investor sentiment and retail sentiment in terms of wanting to buy these stocks is even worse than it was simply because of inflation, is a hard sell. So that's the first argument. It seems like it's hard to find where else the market could react for there to be a massive bottom. Number two is the market might be baking in inflation rates already, right? Like we've already baked in when the Fed minutes came out in January and and the market crashed, right? They baked in interest rates are coming. Seems like now Jerome Powell talked. After he talked, the market crashed a little bit. They bake some of that in. Like it's getting to the point where when the Fed says something, unless it's astronomically horrible or some data comes out that's astronomically bad, the market seems to have baked it in. Because again, stock prices are so low. Everything's been so decimated that it seems like a lot of this information is cooked into these prices and we're fine. Look at a stock like Twilio. Twilio was at $199 yesterday. They had absolutely amazing earnings after hours. They went up to $240. Like That means if even if you have amazing earnings and the market still feels like the macro economy sucks for growth stocks, you should not be going from 199 to 240 in after hours. Like that shouldn't be happening, because if you have amazing earnings, it should be like, all right, you have good earnings, but let's see what happens with the rest of the market. But the market's rewarding a company doing that because they believe that they'll be able to persist even in the market that we're currently having with all the bad stuff that's going on. So there is a world in which these interest rates are already baked in. Number 3 is supply chain issues. Look, if supply chain issues are getting better, then this inflation will start to go down. The White House just released a report that by the end of 2022, they believe that inflation will ease. I don't know if they're lying. I don't know if they're saying the truth. But one logical argument is that if supply chains get better and supply chain bottlenecks start going away, which we've seen start going away. I did an analysis on what Kathy Wood's analysis was on that yesterday. Then this inflation with rate hikes would necessarily mean that inflation starts to go down. This supply chain problem with rate hikes would allow interest rates to go down. The Fed is definitely going to raise interest rates. The question is how much they're going to raise it by. And it seems like the market is baking in that they're going to raise it 25, 50 points, but we kind of don't care because it's like stocks are already down and supply chains are getting better. So even if they raise it 25 basis points, if supply chains are getting better, then we don't need the stock market to crash even more, right? Because that is going to naturally get rid of inflation, because there's going to be more inventories, which means there's going to be less demand, which means there's going to be more supply than less demand, which means prices are going to go down. Inflation naturally is going to start to go down with the coupling of interest rates hikes, which shouldn't mean that it's going to be a tragedy or the apocalypse for the stock market, because all of that is already baked in. So even with the Fed raising interest rates and supply chains getting better, that shouldn't necessarily be the worst thing in the world. Finally, where else are you going to put your money, right? Like this is the next thing. Like when you're not putting your money in stocks or the market, you have to put your money somewhere else. So where can you get a better return? You're not going to get into gold. The price of gold was $1,000 per ounce in 2010. The price of gold today is $1,800. That's not even a 2x return over more than a decade of per price of ounce of gold. Gold is not getting you more money. Cash is literally not getting money because you're losing value on your class due to inflation. Real estate, maybe, but most average people can't invest in real estate. When I mean average, I mean, most people that just have a phone, right? Like people just don't invest in real estate, but stocks, especially with the new digital trading world that we're in, where average people, retail investors are able to trade, it seems like the market might be a good place to put your money if there is nowhere else to put your money, right? It's either real estate, you hold on to your cash, or like a gold type of asset. Now, crypto, you could say it as well, but crypto's not a different story. Crypto is moving with the markets. I mean, crypto went up today because of the inflation reports, but when the market crashed, crypto crashed as well. I mean, crypto, Bitcoin, Ethereum, they are not inversely related to the stock market. They are following the stock market very, very similarly. So it's hard to believe that if you put your money in crypto, it's not the same as putting your money in the stock market. You may get a better return just to the nature of how volatile crypto is. But if you put a lot of money in crypto and growth stocks and the market in general, if one declines, the other one is likely going to decline. I mean, if the market declines, crypto is likely going to decline. I don't know if crypto declines, the market's going to decline, but crypto seems to be related definitely to the market. So it seems like there's just a variety of reasons for why the market is seeming to form a bottom. They don't necessarily care about all the news that's happening because they know supply chains are going to get better. They know interest rates hikes are already coming, which means that inflation is going to get better with those hikes. And they also know that the bottom is starting to form because the prices are already so devalued. I mean, Facebook lost $300 billion in market cap. Like, what more else do you want from this market? How much worse can it get? You talk about the dot-com bubble crash. Stocks were down 78%. Stocks are down 70 to 80%. Like, it's not a joke. That's literally what has happened with so many of these stocks. So it gets to a point where you're just like, well, how much worse can it get? How much lower can it actually get? And then on top of that, if that bottom is formed, then sentiment starts to get better and people start wanting to buy more because they feel like there's more optimism. As a result, more money goes into the market and the market potentially rallies. Now, could the market rally and then crash because of something else happening? Possibly, but as of now, putting all the pieces together, it looks like there is a potential bottom forming. I don't know if this is necessarily true. I don't know if there's going to be something that happens in March that totally crashes it. The interest rate hikes actually weren't baked in, and the Jerome Powell says something and it makes it worse. You could imagine inflation potentially going to like 12% in the next 2 months, and then that's just astronomically worse, right? Because it's only supposed to be going up a little. In fact, it's supposed to be going down. Lots of things could happen. But right now, at this moment in time, putting the variables together, it seems like there is a path to go forward. But we will eventually see what happens. As of now, growth stocks are being resilient to rising inflation data from the Fed. So thank you guys for watching. Let me know your thoughts in the comments. Let me know if you have any challenges to these ideas. I do want to know what other people are thinking, how other people are thinking about the macroeconomy in relationship to stocks and how they are rising or will potentially be falling. Thank you guys for watching. My name is Amit. Looking forward to reading the comments. I'll see you in the next one.